For a sole trader, which is actually a form of business organization that is owned and managed by one person, they normally prepare two main statements. Statement number one is what we call the income statement. Sometimes we call it the trading profit and loss account. Sometimes we also refer to it as the statement of comprehensive income. And the purpose of that statement is to determine the amount of profit or loss the business was able to generate or incur in that particular period of time, normally 12 months. So from the first month to the last month, how much sales did we make? What were maybe the sales returns? What were the expenses? We do those computations in the income statement so that we can arrive at the profit that we made or the loss that we incurred in that period of time. So this one talks about incomes and expenses or incomes and costs. The cost that we incurred versus the income that we generated, we do all those computations in form of a statement so that we can be able to arrive at the profit or loss. That one, we did it on Sunday with Mr. Ezra. Here now, I'm going to take you through the statement number 2, which is known as the statement of financial position. Sometimes we also refer to it as the balance sheet. In this statement, we want to know the value of assets, capital, assets. First of all, let me deal with it. We know these are the resources that we own. So by the end of the financial year, after operating for 12 months, that is a financial year, how much is the value of our assets? What we own. And these assets, we know, they comprise of the fixed, also referred as the non-current assets. These are items like land and buildings. Sometimes we refer to it as the premises. We have things like the equipment. We have things like the furniture and fittings, machines, motor vehicles. All those are referred as the fixed assets. So by the end of the financial year, we want to know what is the value of all these fixed assets that we own. Still under the assets, we have those assets we refer as the current assets. For the fixed assets and those assets that are going to be used in the business for a considerable long period of time, more than one financial year, we normally acquire them with no intention of selling them, but to facilitate in the smooth running of the business. These assets that we are referring as the fixed or non-current assets, they are going to serve the business for a long period of time across a series of financial years. So after every financial year, we need to evaluate what is the value of the assets that we have. Then on the current assets, we have things like the inventory, also known as the stock. And this one we normally use the closing stock, the value of the closing stock. By the time we are ending the year, in our warehouse or store, we have stock worth how much? That is still our asset. We also have the accounts, receivables, also known as the debtors. Those customers who bought goods on credit but they have not paid, they are the accounts receivables. So they owe the business money. It is our money but not yet received. We also have things like the prepaid expenses. You can relate that with what we did on the end year adjustment. We said that any expense that we have paid in excess by the end of the financial year, because we have not utilized that money, still our money, therefore it is an asset to us. And the accrued income that we have already earned but not yet received. Maybe there is a tenant who has not paid some rent to us. It is still an asset to the business. Then we also have the cash in hand. This is the cash or the petty cash or the cash in the cash box and the cash at bank, which is simply the bank balance. All those are current assets. So at the end of the year, again, we need to know what is the value of this. Then we need to also compare now with what we call capital. Capital is what we call the owner's equity. How much the owner has invested in the business. And then lastly, we talk about the liabilities. The liabilities are the business obligations or the business debts by the end of the financial year. Those that we have not paid. And here again, we have the long-term liabilities. For the sole trader, this one is going to be the bank loan. If the sole trader has acquired maybe a 3-year loan, it becomes a long-term liability. Then we also have the current liabilities, which comes in the form of what? Accounts payable. The current liabilities here, we shall have the accounts payables, also known as the creditors. This is an amount that we have not paid our suppliers by the end of the financial year. We have not paid our suppliers that amount, so it is a liability. We also have what we call the bank overdraft. If we have overdrawn our account, it is a liability. We also have what we call accrued expenses. And lastly, we have prepaid income. All those are liabilities. So what you need to understand is this. There is somewhere we talked about the accounting equation. We talked about the accounting equation somewhere, and we say that at any given point, assets must be equal to capital plus liabilities. So the total value of assets, both current and fixed assets, if you add the values of all these assets, both current and fixed, they should be equal to the value of capital and liabilities. They should be equal to capital and liabilities combined. Assets must always be equal to capital and liabilities. Here we have capital and liabilities. If we add them, they should be equal to the value of the assets, both fixed and current assets. Because we normally say that these assets that we have, they must have been financed using either capital or liabilities. We bought them using the owner's money that he was invested in the business, or we bought them by credit. We can take a loan and go buy the motor vehicle. We can have this inventory that we are talking about here, but it was bought or acquired on credit. So we have accounts receivables or payables, accounts payable or creditors. There's a bank overdraft that was acquired here, and then maybe it was used to finance a particular asset there. So the value of assets must always be equal to the amount of capital and liabilities. So this information now is going to be organized in the form of a statement, and that statement that comes out, whereby we capture the assets, capital, and liabilities, is what we call the statement of financial position. The statement of financial position. The other thing that you need to note on the fixed assets, these assets, because they are going to be in the business for a long period of time, their value keep on reducing through what we discuss as depreciation. So we shall be deducting depreciation so that we can be able to know the net book value, which is the same as the remaining value on those fixed assets after undergoing depreciation. And our interest is to know the net book value of these fixed assets. By the end of the financial year, the assets that we own, they are worth how much? They are worth how much? How much is the value that is remaining on them? That is the most important thing. We are not interested with how much they costed us. We are interested in reporting the value of the assets that are still in the business. So The statement of financial position, therefore, will have the following format. How do we list or capture these items that we have listed them here? So, statement of financial position, we normally start with the business name. Make sure you have captured the name of the business, will be provided in the question. And then below that, write statement of financial position as at a particular date. You insert the date that is in the question. So you can be told to prepare the statement of financial position as at 31st December 2022. So here you write as at 31st December 2022. Then you underline your heading. That is the heading part. Then start with the fixed assets. These assets, we have said, they undergo depreciation. So here you will come and do capture their cost, capture their accumulated depreciation, capture their net book value. Then you list the assets that are captured in the question. Maybe there is a premises or land and building. What was their cost? How much have they lost with depreciation? The net book value is simply cost minus depreciation. You get that, the remaining value. You talk about maybe motor vehicle. How much was the acquisition cost? How much have they depreciated by? What is the remaining value of the net book value? You go capture furniture and fittings. Furniture and fittings. What was the cost? How much is the depreciation? What is the remaining value? You also have things like the computers. The same thing. After listing all of them as per the question, you don't need the value of the cost. We don't need the total of depreciation. All that we need is the net book value. That is what we shall add and get the total net book value of all the fixed assets. Once that is done, come below that and then capture the current assets. Those assets that are short term. So here we have things like the inventory. You can list them there. Debtors or accounts receivable. And here, you need to do an adjustment if you are given provision for depreciation. So just take the amount of the debtors that you are given minus the provision for doubtful debts. You subtract the provision for doubtful debts. You will get the net accounts receivables. Then we are going to have things like the prepaid expenses. That is an amount that we have paid but we have not utilized. We also have here the accrued income that we have already generated but we have not received. Then capture here the cash in hand. Then also capture the bank balance. You get the total current assets. So the net book value and the total of the current assets, they should be in the same line so that you can add them, this plus this, you get a figure there, which we call the total assets. The total assets. That is the figure there. The total value of assets in that financial year. That. Once that is captured, now you ask yourself one question, a very valid question. If these are the total assets, how did we acquire them? How were they financed? You come here and say they were financed by Part of them, they were financed by capital. Capital requires some keyword adjustment. This is the opening capital for the period. You are, if the business generated net profit will increase the capital. You add net profit for the year, then you raise any drawings. Remember drawings, it is an amount the owner will deduct from the business for his or her own personal use. So if you have a business and you go and take some money or some resources from the business and you go use them for non-business issues, you have reduced your capital that you had initially invested there. So you deduct any drawings so that you can get the closing capital. Some of them or some of the assets were financed by that capital. Others were financed by long-term liabilities. For the sole trader, the long-term liability is normally the bank loan. You put it there because it does not have another figure that you are going to add to it. So if you want figure, put it there. And then lastly, you capture now the current liabilities, which normally come in the form of trade payables. Trade payables are the same as the creditors. And I've told you it is an amount that we have not paid our suppliers, an amount that we still owe the suppliers because of the credit purchases that we made from them. Put it here. Say, if there is a bank overdraft, put it there. If there is a accrued expense, an expense that we have not paid, put it there. If there is a prepaid income, put it there. Those are the possible liabilities that are going to be in the current form. They are short-term liabilities. Add the total, put it there. So here we have the closing capital, we have the long-term liabilities, we have the current liabilities. So this is capital and liabilities combined. Add them so that you can get a figure there. Then that one we call total capital and liabilities. That figure. If all is well, this figure and this figure, they should be the same. The total assets and the figure for capital and liabilities, they are supposed to be the same. And that is the end of your statement. That is your end of the statement. So that is how we arrange them. Start with the fixed assets at the top, then come to the current assets, then you add the net book value of the fixed assets, you combine with the current assets, you will get the total assets. This is we are only interested in the net book value. That's why here we do 2 lines to close that. We don't need those totals. Even the figures that I'm going to write below here, they are not going to be added to this because I've already closed that. So we add this and the total current assets, which is here, we get our total assets. Then the question is, how are those assets acquired? Because they are resources that are still in the business. How did we acquire them? Part of them, they were bought using the money that was invested by the owner, that is capital. And that capital, which we started with at the start of the year, might have increased because of the net profit. So we add the net profit, we deduct any capital amount that was withdrawn by the owner for his or her own personal use to get the capital by the end of the year. If there is any long-term liability that we are yet to clear, you put it there. And then these are the short-term debts the business owes in the form of the creditors, overdraft, accrued expenses, or prepaid income. We get them and we total, we get that figure. If we add them, we get the total capital and liabilities. And that becomes your statement of financial position. So it is very easy. And the other thing is just remember in an examination scenario, we don't mark the final answer, we simply mark the entries. Every correct entry that you make, it is a mark. Every correct. So if you capture these words very correctly, you get the depreciation correctly, you determine the net book value correctly together with that, those are marks. You can't here capture the inventory under the current assets. Remember, don't mix. When you are stating the current assets, make sure that you are stating the current assets. Don't mix and then you find that some of these are liabilities and they are not assets, because you can find somebody capturing here like the creditor. Creditors are not current assets. Overdraft is not a current asset. Let the items and each and every category be the correct items. You get that? You get that? So the figure goes on correctly. You can't here determine that. So as you move, you are accumulating marks. Even if now from there, maybe you do some mistakes down here, and you find that this is not correct, but maybe up to there you are correct. Maybe here you did a mistake, you picked a wrong figure. This one is correct, this one is correct, this one is correct. Because this one is wrong, this one is also going to be wrong. You have earned very many marks. Accounting, we don't mark the final answer down there. We mark entries as we move along. One, before we start even marking about the entries, the format must be correct. The format must be correct. And then, you as a student, your work is very simple. Just note what is a fixed asset and what are the items that qualify to be called fixed assets. Make sure that all of them are here, so that when you are doing the fixed asset, we should not expect even the current assets to be there. When you are capturing the current assets, you don't expect fixed assets to be there, and all that. Categorize them correctly, and make sure that you are as accurate as possible, and the statement is done. There is a document that I shared with you on WhatsApp, and I want us to use that document to demonstrate what I am saying here. So there is the first question there, question 1, talks about on that 1st of December, the following balances were extracted from the books of Denmark's enterprises. So we have been given the balances there. And then now we are told at the foot here, we have the additional information. The additional information I told you, that is what we call the end year adjustments. One is about depreciation on furniture and fittings, which is provided at the rate of 12% per annum on cost. If you remember when we were doing the end year adjustment on depreciation, I told you anytime it is on cost, then you are calculating depreciation on straight line. Straight line is on cost. If it is on net book value, it is on the reducing balance. Number 2, depreciation on motor vehicle is provided at the rate of 20% per annum, still on cost. Number 3, there are bad debts of that 2,600, which are to be written off. Those debts we have confirmed that they are not going to be recoverable. And remember, the bad debts, they come as a result of debtors. And the debtors, we have said, they are also known as the accounts receivable. So out of these accounts receivables that we have here, we have that 2,600 that we have confirmed that will not be received. So we need to minus or to deduct them from here so that we can get the net account receivables. And then you are told that the net profit for the year was 7,500. That one should be added to the capital. And if you look at this, we have the drawings, we have the opening capital. So we shall take this opening capital, we add the net profit, we deduct these drawings of 160,000 to get the closing capital. And the point is that we are supposed to prepare the statement of financial position as at that 1st of December 2021, and you get your 12 marks. So it is just a matter of arranging them: fixed assets, current assets, then we go to capital, long-term liability, then we finish with the current liabilities. For the fixed assets, we must remember to do the depreciation. So well, that is good enough. You can be able to refer from your gadgets as I go to the board. So I want to edit this. For the business name, we have it. It is known as Denmex Enterprises. The statement is prepared as at that 1st of December 2021. Then we go to the fixed assets. What are the assets that we have here that are of fixed nature? One is the motor vehicle. How much is the cost of the motor vehicle? 2350,000. Then we are told down there about depreciation on motor vehicle is provided at the rate of 20% per annum on cost. So the depreciation is on cost. So it is going to be what? Motor vehicle depreciation, we are told is 20% times the cost, which is 2350,000. How much do you get after doing that? 20%. Somebody to do it. Point 2 times 2350, you get it is 470,000. That is the depreciation for this year. If you go through the question, there's somewhere that is written there. Provision for accumulated depreciation on a motor vehicle is 940,000. And remember there, it is written into bracket 1st January 2021. That simply tells you that by the start of the year, already the depreciation for this motor vehicle was 940,000. Already they had lost 940,000 before the start of this year. So these motor vehicles have been used in the business for several years. So in those previous years, those motor vehicles had already lost what? 940, sorry. And then this is for this year, this is for the previous year. So we need to add them so that we can get the accumulated depreciation. We add the two. The one that we have calculated is for this year only, because the statement is being prepared as at that 1st of December 2021. So from 1st of January to that 1st of December, it has lost this one, this year. This one is for previous years. So the total depreciation now, from when they were bought up to this date that we are reporting, is going to be how much? So for 70,000 plus 940,000 gives you a figure of 1,410,000. That is now the accumulated depreciation. Note that. So when you are doing the accumulated depreciation, don't use what is captured in the question. what is normally captured in the question is the depreciation from the previous years. So you need to calculate for this year and then add to that depreciation that was from previous year so that you can get the accumulated 1,410,000. Then if you take this minus this, 2350 minus the total depreciation, the remaining value is now 940,000. That is the value for the motor vehicle that is remaining. They were acquired at this amount. Up to this date, they have lost this, so the value remaining is that. In simple terms, we are supposed to use them for 2 more years, because the next year they are also going to use for 70. Then the other year, they use another for 70. For 70 times 2 years, 940. They can serve us for 2 more years. The value that is remaining is enough for those motor vehicles to serve us for 2 more years. But that is not important. The value at the end of the year is that. Which other fixed asset is provided here? We have furniture and fittings. F and F. Furniture and fittings. They were acquired at a cost of 300,000. And how much have they lost? We go to the additional information first. Roman 1, depreciation on furniture and fittings is provided at the rate of 12.5% times on cost, times this cost. You get that 7,500. 37,500. Whatever you have calculated is for this year, and then under the balances you are given provision for accumulated depreciation on furniture and fittings is what? 501,200. So this is for this year. Then for the previous, we have 501,200. If you add the 2, that figure comes what? You get 5, that's 8, 700. 5 plus 8, 700, which is now the accumulated depreciation. But now here the cost is more than this, so it looks like the value is going to be negative. This one is 2 plus 8. And it is negative. It is negative. Very rare would you have such kind of an answer, but that is how it is. The provision, yes. This is the cost, 300,000. Accumulated depreciation is this and this. They are actually having a negative net book value. But that is how the question is. I think those are the only 2 fixed assets. They are the only fixed assets in this business. So this one we don't require the total. This one we don't require the total. We total the net book values. We get 701, 300, the net book value, because this one is negative. If you add this to this negative, you get that. Then come here and capture now the current assets. Current assets, they don't depreciate, so you just list them. Let's see. From the top, we have accounts receivable. This one will be affected. Remember, these are debtors. There is additional information number 3 that touches on them. Bad debts of that 2,600 are to be written off. So the accounts receivable, what we were expecting to receive is 158,600. But out of this, 32,600 will never be minus what you are not going to recover, so that you can be able to now determine the amount that will be recovered from the debtors. Minus that 2,600, you get 126,000.
Hi, Mwalimu.
Yes.
Kindly repeat on how you've arrived at the net book value for furniture and fittings. I haven't understood that bit. Yes.
You can be able to start with the question, right?
Yeah.
It is written there, furniture
Yeah.
and fitting at the cost, eh?
Mm.
Then we are calculating the accumulated depreciation. So we calculated the 12.5% of this cost. Eh?
Yeah, yes. I got that.
And then, if you look at the question, there is also the provision for accumulated depreciation on furniture and fittings.
Yeah.
And have you seen it?
Yes.
Provision for accumulated depreciation. And I've told you the figure that will be provided there for accumulated depreciation is for the previous years. 501,200 plus what we calculated, that is 12.5% of 300,000. If you add the two, they give you this. That is why we call them accumulated. Eh? You accumulated them. Are we together? Now,
yes.
As accumulated depreciation, we are supposed to get the net book value. You take this and this, you see the figure here that we are subtracting is higher than this. So the answer here will be negative. Eh? 300,000.
Oh, you take the cost minus the accumulated depreciation. Okay, I got it.
Even this one, motor vehicle, we took this cost, accumulated depreciation plus to be able to get that.
The net book value.
Yeah.
Okay, that's okay.
Accumulated depreciation. Good.
Thank you.
Okay.
Okay.
So for the accounts receivable, this is what we shall expect to get after we have written off the bad debts that have been confirmed of that 2,600. That is done. What is another current asset? We have inventory. That is stock, 44,150. Then we also have the bank balance. This is 47,300. Don't think whether we have any other current assets. You do the totals. 126,000 plus 44,150 plus 47,300. You get 217. If you add now with the net book value for the fixed assets, you get 918. So that is what we call the total assets. And we make sure that you underline with the double lines. That is the total. Then you ask yourself very valid question: how are these assets financed? Financed by one is capital. They were financed by capital. How much is the capital amount at the start of the year? 1st of January is 111,500. 111,500. Then this capital was increased because of the net profit that we earned. We earned a profit of 7.5. 300. That is under the additional information number 4, the net profit for the year. So that net profit increases the capital. Then we deduct the drawings, what the owner will deduct from the business for his or her own personal use, 160,000. So that now we can be able to determine the closing capital amount. We get here it is 1,006,800 closing capital. We have a long-term liability. You look whether there is a bank loan there. And it's like we don't have the long-term liability. We don't have bank loan. So we just capture now the current liabilities. Accounts payable. How much do we owe the suppliers? So that's 1,950. Do we have any other? Actually, it is like the only one.
Excuse me, Malim.
Yes.
Are we supposed to add drawings? We haven't deducted.
I've seen that. I've seen that. This one is wrong. We added instead of subtracting. 111,500 plus 735,300 minus 160,000. That is 686,800. Thank you. You are supposed to do that. Accounts payable. Actually, we don't have any other current liability. We don't have a bank overdraft. We don't have any accrued expense. So this one, instead of having it here, you can simply bring it here. So that one. We normally put them here so that we can do the totals and then transfer the total. Now that it is only one item, just take it to the last column direct. So if you add the capital and liabilities, how much is that? We get it is 918. Total capital and liabilities. And actually it is true. Assets are equal to capital plus liabilities. So the total figure for the assets there, the total figure for the assets is the same as the figure for capital plus liabilities. That is all. That is all. That is all. Any question? So if you look at question 2. The following balances were extracted from the accounting records of memory suppliers as at 30th September 2011. So we are given the balances and also their adjustments in the additional information to be made. One, motor vehicles to be depreciated at the rate of 20% per annum on reducing balance basis. That now is not on cost, it is on reducing balance basis. Number two, as
Sorry, Maureen,
yes,
Maureen, please share the question with us, please. Maybe on WhatsApp.
sorry,
Please share the question with us, maybe on WhatsApp.
for
It's
those
on the WhatsApp group.
you are not on the top.
I am, but I don't think I can see that question.
I just shared it, or I shared it in the wrong group.
It's on the WhatsApp group.
I shared it for the group on Saturday. Are you in the WhatsApp group of Saturday?
Yeah, yes, I am.
There is no document that is there. Just a minute, let me find out. Actually, the last item that is there, but it is not the others, the other members for the Saturday. Are you able to get that question?
Yes, Mwalimu, it's there.
Yes,
At 10:03.
Yes, at 10:03. It is the last item that is in that WhatsApp group.
It's great. Whoever is seeing it, please share. Maybe some of us have a problem because we can see it. I think maybe it's only me, but I can see it.
So you want it to be shared in the same group?
Yes. Thank you. Sorry for disturbance.
Okay. I will share. I hope now you have received it. Or maybe you are in a different, we have got many groups. There is a early morning WhatsApp group. There is a Tuesday evening WhatsApp group. And there is a WhatsApp group for Saturday. You might find that you are in a different WhatsApp group.
Maybe, but thank you.
Okay, but if you have my number, you can just request it. I send it to you directly. You have my number?
Yes, thank you. I'll share with you. I'll contact you.
Just say hi on WhatsApp group and then I forward to you. Okay, as I thought our friend, we should be now reading through the question. As at the 30th of September 2011, we are told that salaries and wages outstanding, those are accrued, they have not yet been paid. And we said when they have not yet been paid, we do two things. To the salaries and wages that we are given here, we shall add that figure. And then these salaries and wages, because they have not yet been paid, they are also going to be current liabilities. They are also going to be current liabilities. Then rent and rates was prepaid. Prepaid, we said we paid in excess. So rent and rates, we are going to deduct. Rent and rates, we are going to deduct that. Where we have rent and rates, we are going to deduct that. And then what you are required to do in this question, we are required to do two statements. One is the statement of financial performance. It is the same as the income statement. It is the same as the profit and loss, so that we can be able to determine the net profit or loss. Then the net profit or loss that we are going to get from this statement number one, it is going to be added to capital in a statement of financial position. So in simple terms, they want us to get the net profit ourselves. It is not like the other question that we have done whereby the net profit was provided. Here they have provided the gross profit. So we need to adjust this gross profit to get the net profit, which will be added to the capital when preparing the statement of financial position. So this is how you go about it. So this is memory suppliers. One is the statement of financial performance. Let us start with that. I know you covered this with Mr. Ezra, but now this one is not comprehensive. We are not starting from sales, less cost of sales and all that. We are simply starting from the gross profit. Memory suppliers. The statement of financial performance or the income statement, it is normally dated for the year ended. That is the difference. For the statement of financial position, we write as at. But this one we normally use for the year ended. Then we capture the date. The date is going to be always in the question. Then this one now we are told to do just the profit and loss part. You have already been given the gross profit. I know you are told that gross profit is obtained or derived from sales minus cost of sales. That one was done for you. So they have the gross profit figure. And we are told the gross profit is remember these figures are in thousands. So the gross profit amount is 5570. Then you are told that once you have the gross profit, you need to find out whether there is other incomes, like for example, rent income, commission income, interest income. You add them to the gross profit, including discount received. If there is any, you add them here. So you need to confirm. From top, we have motor vehicle accounts receivable, motor expenses, rent and rates. Discount received is there. It is added to the gross profit. And it is 46. Wages and salaries, accounts payable, provision for depreciation of motor vehicle, carriage out, cash at bank, drawings, gross profit, inventory, and capital. It is only the discount received which will be treated as other income. Apart from the buying and selling of goods, there is also the discount we received, which normally increases our gross profit. So we shall add that to get total income. It's a 616. That is the total income. Then from the total income, now you less all the expenses, operating expenses. Here, let us go, but we should also remember that there is some additional information that affects some expenses there. One, we have motor expenses. The motor expenses as per the question is 230. Two, we have rent and rates. These ones are affected by the additional information. As at 30th September 2011, rent and rates was prepaid by 150,000. So the rent and rates figure in the trial balance, it is 250. And then we are told there is a prepayment. So we paid excess of how much? The prepayment is 150,000, but here now you are going to use 150 because the 3 zeros are already taken care of there. So under the additional information, they are using the full amount, but in the balances they have removed the 3 zeros. So we also remove 3 zeros so that the figures can be compatible. 250 minus 150, that one is going to be 100. Then discount received, that is an income, wages and salaries. They are also affected by the additional information. As at 30th September 2011, salaries and wages outstanding was 280,000. So how much did we pay for salaries and wages in that year? 2420. And then outstanding means that we have not paid. So again, we have not paid 280. So how much were we supposed to pay? So you were supposed to pay 2,700. That. So for the prepayment, you rest. For the accruals, you add. We go on. Account payable, that is not an expense. Provision for the, we need to calculate now here depreciation on motor vehicle. And we are told clearly motor vehicles are to be depreciated at the rate of 20% times on reducing balance basis. On reducing balance, I told you, you do the depreciation on the net book value. You don't multiply by the cost. So we are given the motor vehicle cost is 15,000 there. But now you are told it is depreciated at 20% on the reducing balance. So you are going to take the cost, which is 15,000, you minus accumulated depreciation or provision for depreciation on motor vehicle, which is 1,500, which is given there. That is the difference between the times or on cost and on reducing balance. If it was on cost, we could have done 20% of 15,000 direct. But when it says that it is on reducing balance, you need to deduct the provision for depreciation already provided in the question so that you can get the net book value. That net book value is what you multiply by the rate of depreciation. Kindly note that.
Can't Mwalimu repeat on that, on the depreciation on motor vehicle?
We have got two methods of doing depreciation. We have got two methods of doing depreciation. In the previous question, if you look at this question here, in this question that we did as question number 1, question number 1, look here, they were saying that depreciation on furniture and fitting is provided at 12.5% per annum on cost. In that question, what did we do? We simply did 12.5% times the cost of the furniture and fittings, which is 300,000, because we are told times cost or on cost, so we multiply by the cost. But in this question that we are now doing, we are told that motor vehicles are to be depreciated at the rate of 20% per annum on reducing balance. So if it is on reducing balance, you don't multiply by cost. You first of all take the cost, you deduct this provision for depreciation so that you get the net book value. After getting that net book value, now you multiply the net book value by 20% to get the depreciation. So on reducing balance, we are calculating depreciation on the net book value. The remaining value of that asset after deducting the depreciation for the previous year. So that is the difference. That is the difference. So kindly note that. Kindly note that when the question is telling you that it is depreciated on reducing balance, sometimes they cannot tell you on reducing, but they tell you on the net book value. You must take the cost of the asset minus the depreciation that is provided there. You get the net book value, and now you multiply by the percentage rate of depreciation. So that is it that I mean here. That's why we have done 15,000 is the cost minus accumulated depreciation. We get the net book value, and then we multiply by 20%. I'm getting 2,700. So you first of all get this minus this, that is 20%. Good. Carriage outward is an expense. Okay. This is the cost you incurred to offer transport for your customers. It is carriage on sales. Carriage outward is carriage on sales. So as you sell goods, you might offer after sales service transport for your customers when the goods are being delivered to the customer. So that is the cost you incur to deliver goods to your customers after you have sold them to them. Good. Cash at bank, that is not an expense. Drawings is not an expense. Gross profit is captured. Inventory is not used here. Capital and that. So the issue here, just remember that in the income statement, our focus is normally incomes and expenses. We don't deal with assets here. Cash at bank is an asset. Inventory is an asset. Even the motor vehicle themselves, they are assets. We only deal with the depreciation. And the depreciation that we put here is the one that we have calculated. There is that provision of 1,500. It will not appear here. In the income statement, we use the depreciation that we have calculated only. Good. Then let us know how much expenses were they. 230 plus 100 plus 2,700 plus 2,700 again plus 410 gives you 6140. This is our total income. This is our total expenses. The difference between the two will give us the net profit. 16. We get 24.76. That is the net profit for the year. So this is now the figure that we shall add to the capital to get to the closing capital. We said capital plus net profit minus drawings, it will give us the closing capital amount. So this is what we use. 24.76. Let me have it down so that I will use it when we go to the next statement. Any question on that? Silence means that you are comfortable. We do the other one. Oh, sorry for that. The other statement. So what will change is here the statement of financial position. This one now will be statement of financial position. Then we are saying we use as at that 1st of December 2011. That is the difference. The other one we say for the year ended. This one we say as at the date provided. So as usual, we start with the fixed assets. So for the fixed assets, it is only one motor vehicles. The cost is 15,000. But now when we are doing accumulated depreciation, remember we have the 2,700 that we have calculated, which is only for this year. We also have 1,500 that was provided there as provision for depreciation. When you are doing now the statement of financial position and you are looking for the accumulated depreciation, you add the two of them. In the income statement, I've told you, you only use what you have calculated because that is the depreciation for that year. And we are interested in the expenses for that year only. So that's why we use the one that we calculated 2,700. But here in the statement of financial position, you want to know the net book value, the remaining value on that asset. So under the accumulated depreciation, we will use 2,700 for this year plus the 1,500 for the previous year, so that we can get the total accumulated depreciation to date up to this date from when they were acquired. Right? So do 2,700 plus 1,500, that gives you 4,200. We have lost a total of 200. So 15,000 minus 4,200 gives us 10,800. We don't need that total. We don't need that total. We only need this. That is the value of the motor vehicle as at that date. After the current assets, one, it is accounts receivable. This question, we are not given provision for LTIF debts. If you are not given, then that figure remains the way it is. The whole amount we expect to receive is 850. The next thing is cash at bank. Which is 1060. That is simply the bank balance. Inventories. $500. Then look at the prepayments and the accruals. If there is any prepaid expense, it is an asset. Here we have the prepaid rent and rates 150. We remove the 3 zeros because they are captured at the top there. That is all. Sum them. So 560. This plus this gives you now the total assets. 18 to 60. Once you have your total assets, ask yourself, how are they financed? They were financed by capital. The capital amount for the start of the year is 570. Add the net profit. What we got from the other statement, 2476. In this question, no drawings was given, so we don't have anything less. $570 plus 2476, you get 11,046. Then we have the bank loan. If it is there, that is a long-term liability. If it is not there, we don't have long-term liability. Actually, we don't have. So we don't have long-term liability, no need of writing.
Excuse me.
Sorry?
Excuse me. Where you've written capital as 8570, I'm a bit lost because the capital here is indicated as 14,984. Or maybe there's something I'm missing.
Oh, I've just taken actually the figure for gross profit. Okay, yeah, 14,984. Correct. Actually, I picked the figure for the gross profit. I don't know why. 14,984. Thank you. Plus 24, 76. 17 for 60. 17 for 60. Thank you for that. Current liabilities. What are they? Are we given the payables? Yes, we have the accounts payables there. The creditors, what we owe the suppliers. Accounts payable, 1850. And under the accruals and the prepayments, we have salaries and wages outstanding. With a liability because we owe our employees. Outstanding salaries and wages, 280. Add the two. One back. Sorry. I think we achieved something. There was drawings. There was drawings. I've just seen it. If you look at the question, there was drawings of that. Which was supposed to be captured here. Sorry for that. Never saw it. 14,984 plus 2476 minus 12 that. 16 to that. Now it comes to 18. So this figure for the total assets and they are equal to that for capital and liabilities. And you are done. You are done. So it is a matter of being very careful. You can agree with me that you can make some errors. If you could not go through the question clearly, you might find that a certain item has not been captured. Then you realize later on that it was supposed to be captured somewhere. And you have already passed that stage. So it is just a matter of exercising some keenness. Any question on the statement of financial position? So tomorrow when we meet, our focus will be on the questions of this nature, whereby you are supposed to do two of them, and do the income statement and the statement of financial position in the same question. So we are going to emphasize on that, and we shall have done the financial statements of a sole trader. Once we have done that, we still have to do the financial statements for the partnership. Most of the things will be similar, but we are going to have some few adjustments because partnership now, the ownership, it is more than one person. So the profit that they get, they need to share. We need to do what we call appropriation after the net profit. And also there is something else we call the current account, which we are going to incorporate on that. Then from there, we shall go to the financial statements of a company. We still follow the same format, but we have some few additions. The company must pay the taxes, so we need to deduct the taxes. They pay the dividends, we need to capture that, like that. And then we finish with the financial statements for non-profit making organizations. Those organizations that are not profit-oriented, we need to know now how do they prepare their statements. And once we have covered that, we will be done with the financial statements. From there now we can advance to probably the ratios, and then we also prepare. Now we do the financial management part. So I think in the course of next week, I'm going also to put you in groups. There is a lot of theory work that we need to do, and I know we might not have time to discuss that. At group level, you are going to do it, and then you are going to have an opportunity on a particular date to present. And as you present, you also share what you did. You share your documents with the other group, the other members, so that you can exchange those materials. So probably next week, and it is going to be a mixture, in the sense that the Saturday, the Thursday early morning, and the Tuesday evening, all of you are going to be in groups. So you might find that some of your members are in the other classes, but the discussions, we are going to schedule them for Sunday, where all of you normally meet in one class. So that is it for today, unless there is somebody with a question. So good enough. If you are comfortable, let me end the class at that point. Enjoy your Saturday and your weekend. Asanteni sana.
Thank you, Mwalimu. Bye.
Thank you. Bye.
Thanks, Mwalimu. Goodbye.